morning learners, I again welcome you to a new session, that is Stock Market Index. We will discuss today this topic. So I Priyank Sharma from School of Management Studies, Swami Rama Himalayan University welcomes you all to this session. So in this session we are going to diving into a important aspect of the financial markets or the stock market index. Now let's start with the basics of the particular topic, that is index. So stock market index is essentially a basket of selected stocks that represents either the entire market or a specific sector of the market. Then of this, it is actually thermometer. So it tells us about overall temperature or performance of the stock markets. So these indices are carefully designed to reflect trends and gives a snapshot of investors' confidence in the market. So these indexes are the basically reflectors of the markets. So why do we need these indices? So we should know that why we need these indices, and one, they serve as a benchmark to evaluate how well or poorly the individual stocks or the portfolios are doing. That's why it is required. Secondly, they are also helps in understanding investors' sentiment. What is investor sentiment? What the investor think about a particular stock. So when indices rises, it often signals optimism. When they fall, they may indicate concern. Okay. So that means if the markets are falling, they will indicate that it is a concerned area. Globally, there are some well-known indices, or we also tell these indices as indexes, and which includes S&P 500 in US, that is small and poor, which tracks approx 500 large cap, that is large capitalization US companies. Okay, it is the indices of US. Thereafter FTSE 100 in UK, which covers top 100 companies in the Union or UK or United Kingdoms of stock exchanges. Thereafter next indices of the different countries include Nikkei. It is Nikkei 225. It is of Japan. So one of the oldest indices tracking the Tokyo stock exchanges. So that means Nikkei is of Japan. It is one of the oldest indices in the world. Okay, and it states that the 225, that means it consists of the 225 companies track. In India, we primarily focus on two types of indices which represent the different markets, BSE, Sensex and NSE Nifty. So firstly talk about the BSE Sensex. So the benchmark index of Bombay Stock Exchange is the BSE Sensex. Okay, and the second one is NSE, that is National Stock Exchange, that is Nifty 50, it is commonly known as. It is the flagship index of Indian stock market exchanges. Okay, these two are there. These indices helps investors to track the market trends. That means which type of trend it is going in the market. It is an upward trend, downward trend and a constant trend, and make informed decisions by the investors. So that means these particular indices helps in taking the decision making by the investors and taking into consideration the market trends which are going in the markets. Thereafter, as we know that the Indian markets are, or the key Indian markets indices are Sensex and Nifty. So let's talk more about, or let's see more about this particular index. So let's now understand these two major indices of Indian Stock Exchange, okay, in a deeper sense, or let's see what we can understand more about this. So, in BSE Sensex, also known as SNP, BSE Sensex is the oldest stock market index in India. It was established in 1986 and tracks of 30 largest companies and 30 largest and most actively traded stocks listed on the Bombay Stock Exchange. So, these companies are chosen on the basis of some points like market capitalization, liquidity and sector representation. So, these companies are chosen on this basis, that is market capitalization, liquidity and sector representation. When we are going to predict the prices, we need to have a base year. So, base year for this indexes is 1978, 1979 and the base value is considered as 100 as we used to do in the index numbers. So, base year and base value is 100. So, when you see that the Sensex is 70,000 points or 70,000, it means the index has grown 700 times from its base year. That means it is from 100 as the base year, base value, and now it is 70,000. That means it has grown up to 700 times from its base year. Now, Nifty 50 is another leading index which launched in the year 1996 and includes 50 large capitalized companies which are listed on the national stock exchanges. Okay. Again, how these 50 companies are selected from the companies which are listed in the stock exchange? So, the selection criteria is similar in both the indexes with the focus on liquidity, market representation and the capitalization also. For Nifty 50, the base year which is taken is 1995 on which it is compared, and the base value for this particular sense or Nifty is 1000. Okay, and both Sensex and Nifty are widely followed as barometers of the Indian stock exchanges, okay, or the Indian economy, we can say that. The movement which is shown by these indices, that is Nifty and Sensex, these movements reflect investors' confidence, policy impacts, global cues and sectoral trends, that what are prevailing in the particular sector, what are the global cues in the future, what are the impact of particular policy on these markets. These all are reflected by these trends or these particular indices. There are some sectorial indices are also in India. So, beyond these broad market indices like BSE, Sensex and NSE Nifty, India also have several sectoral indices. And these sectorial indices, let us have an example of this sectoral indices like Nifty Bank. So, what does it mean? This particular Sensex or this particular indices is reflecting about the banks, and it tracks major stocks of the banking sector. Thereafter, some indices like, or one more index we have in Nifty, that is Nifty IT. As the name itself suggests, these particular indices reflect the prices of such particular sector. Like Nifty IT includes top technology companies like Infosys, TCS and Wipro. Thereafter, Nifty Pharma, Nifty Auto and so many more indexes are there which reflect the barometer or which are the barometer of this particular sector and reflects the changes in the economic as well as in particular sector. So, these indices actually represent the performance of specific industries, and why they are important Let's see why they are important. Imagine you believe that banking sector will perform well in the coming quarter. That means in the next quarter, that is of June, July, August, banking sector is going to perform well. You think that. Instead of selecting individual bank stock, you could invest in the Nifty Bank Index or a fund that reflects its particular index. It mimics it. We can say that this strategies allows you to get or bet on a sector while spreading out risk. In short, we can say that sectoral indices help to invest in a particular customized form and their portfolios to specific themes or economic forecast, or we can say that this particular sectorial indices helps the investors to frame a portfolio of the particular sectors. Now, how these indices reflect, how these indices are created. Okay, so let's see. Let's discuss how these indices are calculated, which is actually a crucial to understand their movement, and which is required so that we can say that how the movement will move further. We can understand that by knowing how these indices are calculated. So both BSE Sensex and NSE Nifty use the free float market capitalization methodology. So it is a methodology, that is what? Free float market capitalization methodology, on the basis of which these are created. But what does this particular methodology means, free float market capitalization? So let's understand this methodology and try to understand what is it. Actually, market capitalization is equal to the price of share, which is multiplied by total number of outstanding shares. That means total number of outstanding shares multiplied by share price is equal to market capitalization. Okay. And now the second concept is free float market cap. So what is it? So free float market capitalization only considers shares available for public trading. That means shares which are available for the public trading means free float market capitalization. It excludes the shares holdings which are held with the promoters, government shares and other locked in shares. Okay. So we should have a formula to calculate these two concepts and have to know what will be the value of this particular indices. So the formula for calculation of these indices are index value is equal to, that means what we are going to calculate, the value of the index or the indices value is equal to aggregate market base value or aggregate market base value multiplied by base index value. Okay, it is what the formula to calculate this particular aggregate or the particular indices, we can say that. So that means we have a concrete formula to understand or to calculate this particular indices. So after the calculation of these indices, we can have the values that how, or we can predict how the particular index will move on the basis of these aspects or these aggregates. So when the prices of heavily weighted stocks like Reliance or TCS rises, the overall index value also increases significantly. Okay, so that means if we have this type of stocks in our indices and we are going to calculate the value of indices, obviously if the stock price will rise, then value of indices will rise. This system ensures that larger mobility of liquid companies have a greater influence on the index movement, which make its more accurate reflection of the market trends. Okay, so what we said till now, we talked about that what are the market indices and how it reflects. Now let's understand what are the importance of these indices or indexes for the investors. Okay. So what are the importance of the investors, or why the investor should care about or know about the stock market indices, and what will be the impact of these indices understanding on their investment strategy. So investing or investor use it as a benchmarking. So the first one is benchmarking. So investors use indices to compare their portfolio's performance. If your portfolio grew by 10% and the Nifty 50 rise up to 12%, that means your portfolio is underperforming. If the Nifty is rising by 12% and your portfolio is performing by 10%, that means your portfolio is not properly managed and performing under the benchmark. Second one, let's have a index like index funds and EFT, that is electronic traded funds. These all investors to help or all the investors to invest in the entire index instead of selecting individual stocks, and it offers instant diversification and lowers the risk. In India, Nifty and Sensex EFTs are very popular among the passive investors. So two types of investors are there, that is active investors and passive investors. So let's have the derivatives. So indices are also used in the trading of futures and options, that is derivative market. So indices are also used in the derivative trading. So Nifty futures, for instance, are among the most actively contracts which are traded. So traders use them for the purpose of speculation, or it may be used for the purpose of hedging against the market movements. Hedging is what? The securing ourselves by the risk of the market movements. So we can see that the indices play a central role not just in tracking markets but also in the investment strategies, and performs evaluation and risk management. That is what the role of indices. Let's now come to the impact on the Indian economy. That means, what is the impact of these indices on the Indian economy, or stock market indices on the Indian economy. So stock market indices are not just important for investors, but they also reflect the overall economic environment. Okay, that means they are the reflectors of the economic environment too. Okay, so when indices rise, that means the indexes are moving upwards. It suggests that a positive investor sentiment, that means investors are positive towards the economy and they want to invest their money in the economy. So it reflects the economic growth, expectations and stability. And a declining index often signals that the uncertainty, recession fears, or what we can say geopolitical concern of the economy. So that means these are the reflectors of the economy also. These indices reflects everything which are happening in the economy, and by this the investors can understand whether they have to invest this time or grab or keep out the money from the market. So the indices also influence capital flows. We know that if there is positive sentiments or the positive things by the indexes, the flow of the money will be in the market. So global investors track the Sensex and Nifty to decide on allocation of funds to the country. So a strong market attracts foreign institutional investors, while on the other hand a weak markets or the weak form of market can lead to capital outflows. That means if the market is going in the downward trend, the people or the institutions are going to pull back their money. So the policymakers, including the RBI and the government, monitor these index trends to assess the impact of fiscal and monetary measures. For example, if the budget announcement boosts the investors' confidence, the sanctions may shoot up on that particular day. That means the Sensex will go up on the news of the positive news of the budgets. In the essence, indices serve as a real-time economic barometer. That is what the role of the indices in the economy. They reflect the economy, they reflect everything which is happening in the economy. Okay. So in conclusion about the indices of the stock markets, we can say that the indices are the reflectors of the markets, reflectors of the economy, and reflectors of the particular sector if they are sector specific indices. So we can also say that understanding stock market indices is essential for anyone who is participating as investors, as economic formulator in the financial markets. So indices are not just the numbers only, that 70,000, 80,000, 60,000, but they reflect the market dynamics, sector performance, and the health of the economy also. Okay. So these all are about the indices. So as an investor can also frame its strategy and benchmark their portfolio on the basis of these industry, and they can diversify through the index funds and trade as per their investment strategies using derivatives, and these all decisions and these all things are going to be done on the basis of these indices. Okay. So if you are not an active trader, so indices offer valuable insights into the direction of the economy as well as the movement of the particular sectors and the investment sentiments. That is all about the indices. Thank you for this session. We will see you in the next session.